Picture this. It's the year 2034. You're scrolling through your bank account, and instead of the usual fear of seeing how little is left, you see growth. Steady, consistent growth. And it's not from working overtime or cutting back on your favorite lattes. It's from the investments you made a decade earlier that are now paying off. Whether you're 18, 25, or 30, here's the harsh truth. The biggest financial mistake you can make in your 20s is not investing. And the clock is ticking. The choices you make today could mean the difference between financial freedom and a future of what-ifs. So, what's stopping you? Is it fear of the unknown? Confusion over where to begin? Today, I'm going to break down stocks, bonds, and ETFs into simple, actionable steps so you can confidently start building your financial future. Now, I know what you're thinking. Investing? Isn't that for rich people or Wall Street pros? But here's a fun fact. If you've got $50 and a smartphone, congratulations, you can be an investor. But here's the thing. Every day you wait to start investing, you're leaving money on the table. And in the long run, that could cost you far more than you think. Let's start with stocks, the foundation of most investment portfolios. Part 1. Stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially purchasing a small slice of that company's future. If the company does well, your share increases in value. Imagine owning a piece of companies like Apple, Amazon, or Tesla. Yes, that's possible. Here's why stocks are exciting. They have the potential for high returns over the long term. But here's the trade-off. They're volatile. The stock market fluctuates daily, sometimes dramatically. You could see your investments skyrocket one month and dip the next, but that's part of the game. Historically, stocks have delivered some of the highest returns compared to other investments if you stay in for the long haul. But should you put all your money in stocks? Let's hold off on that because we've still got bonds and ETFs to talk about. And trust me, you'll want to hear how they fit in. And before you panic, no, you don't need to know how to day trade or stare at stock charts all day to make money in stocks. In fact, I wouldn't recommend it. Part 2, bonds. Bonds are often called the safe investments. But what does that really mean? When you buy a bond, you're lending money to a company or the government. In return, they agree to pay you back with interest. Think of it like this. You're playing the role of the bank, and they're paying you for that loan. Bonds are generally less risky than stocks because you're promised a fixed return over time. But here's the trade-off. The returns tend to be lower than stocks. So why bother with bonds? Simple. Stability. They can act as a cushion for your portfolio, balancing out the riskier parts of your investments. Especially during market downturns, when stock prices drop, bonds can help stabilize your overall investment. But are bonds alone enough to secure your financial future? Not quite. That's where ETFs come in, and trust me, they're a game changer. Now, if you've ever heard someone say bonds are boring, just think of them as the reliable friend who always shows up. Boring, maybe, but dependable. Part 3. ETFs. ETFs, exchange-traded funds, are the best of both worlds. Imagine a basket that holds multiple stocks, bonds, or other investments. Instead of buying one stock or one bond, you buy a share of the entire basket. This means instant diversification, which spreads out your risk. If one stock in the ETF underperforms, another may rise, balancing the impact. This is why ETFs are perfect for beginners. You get a diversified portfolio without having to be an expert in picking stocks or bonds. Plus, ETFs are easy to trade, just like individual stocks. You can buy or sell them throughout the day, giving you flexibility. But wait, if ETFs are so great, is there a downside? We'll get to that in a minute. First, let's talk about why waiting even just a year to invest could cost you more than you think. Let's talk about time and why it's your most powerful ally in investing. The longer you invest, the more you benefit from compound interest. Think of it like a snowball rolling down a hill. At first it's small, but as it rolls, it picks up more snow, growing larger and larger. The earlier you start investing, the more time you have for your money to grow. Here's a hard truth. If you wait until your 30s or 40s to start investing, you're losing out on thousands, if not hundreds of thousands, of potential gains. But by starting in your 20s, you give yourself the gift of time for your money to grow exponentially. But what if the market crashes? What if you lose money? Stay with me, because you need to hear this. Here's the reality. Markets go up and down. They always have, and they always will. But history shows us that over time, the stock market grows. So, while there may be dips, the long-term trend is up. The key is not to panic during short-term losses. Stay consistent, stay invested, and ride the wave. And don't worry, no one's asking you to be the next Warren Buffett. You just need to get started. Now that you've got a solid understanding of stocks, bonds, and ETFs, it's time to take action. Open a brokerage account, start small, and contribute consistently. This is how you build wealth over time. But wait, there's one more critical piece to this puzzle: your credit score. Without a good credit score, even the best investment strategies can fall apart. That's why you need to watch my next video, where I break down exactly how to improve your credit score. Your financial future starts now. Click on the next video, and let's continue building your path to financial freedom.